Ooh, bombshell tax draft throws curveball at retirement plans, inheritances, and levies on the rich, says Accounting Today. My beautiful better half sent this to me. So I got to do a video on this because it got through the House Ways and Means Committee. So let's read this. Remember, all pending legislation that spends money initiates through the House Ways and Means. The chairman of the House Ways and Means is the most important guy in Washington, D.C. He controls the checkbook. I remember when Charlie Rangel was a chairman of the House Ways and Means. Here's a guy who couldn't pay his tax, who literally tax fraud. Nothing happened to him. Crazy. But if you don't do what he did, you'll be going to jail. All right, so let's check this out. And this guy, look at this guy. Oh, good. Richard Neal chairs the House Ways and Means Committee from look at this guy from Massachusetts. Yeah, I mean, you want that guy in control of the country's finances. Oh, it's embarrassing. I guarantee he's being funded by every pharmacy group, insurance group, financial services organization. I guarantee it. Even though he's a Dem from Massachusetts, lib as can be. All right, so the fight in Congress over emerging tax increases took a dramatic turn with a slew of unexpected proposals from lawmakers. A House committee tasked with drafting the tax needed to pay for the Biden $3.5 trillion spending plan issued a detailed look at what increases on wealthy individuals and corporations might look like. The surprising and unexpected picture from House Ways and Means, the birthplace of all tax legislation, significantly scales back some of Sniffy Joe's original increases, but it also adds new ones. They're expected to vote on the draft, which includes a higher corporate rate, 26.5 later this week. So Trump got it down to, what, 21, 22, something like that, from 33. Yeah, that's whatever, man. I mean, elections matter. So what they're going to do, they're going to increase the capital gains rate to 25%, all right, from 20. All right, so remember, this is just for those in the upper bracket from the 20. If you were paying 20% capital gain, you're going to have a 25% increase in capital gains. You add the 3.8 net investment income tax, the Affordable Care Act, and your rate would be 28.8%. Well below the 43.4 that Biden was seeking. He was seeking to make it ordinary income tax, essentially. Look, I got no problem with that, none whatsoever. The slightly higher rate would, not slightly, it's a pretty significant higher rate, would go into effect in September, not retroactively, but to last April, as Sniffy wanted to do. The old rate would apply to investment gains or losses for transactions initiated before the effective date, but not yet closed out. So that's not going to affect you or me, frankly. So if you already made your trades, you're good. If you haven't made your trades, you're bad. That's all there is to it. Let's see. A managing director with a wealth management firm said, this is a great outcome. Still one of the most favorable rates out there. Okay. It's all signed, he said, that Biden's wish to end the long-standing rule under which a step-up basis won't come to fruition. So basically, Biden wants to change the step-up and basis rules for people making over $1 million, making transfers above that level subject to capital gains tax, but that is now less likely to happen because the two proposals were linked, increase in capital gain and the looking at the step up in basis rules. They're going to raise the top ordinary tax rate to 39.6 from 37%, basically going back to what it was under Clinton. Yeah, under Clinton. And families making over $450 and individuals making $400 would pay that. Those income thresholds are below the levels at which the $37,000 currently applies. So we're going to reduce the amount of income that's subject to a higher amount of money. That's a double whammy. You're going to pay higher taxes, and you're going to have less income to get you in the higher tax bracket. They're below the levels that Biden wants. So Biden wanted to be 452 and 509 instead of the Democrats go 400 and 450. Who are going to pay, again, less income and more taxes, but again, not going to affect the vast majority of Americans. So be it as it may, it is what it is, man. The net got cast a bit wider, said a guy. Let's see. Yep. 3% surcharge. This is pretty interesting. This is interesting right here. The committee proposed a new tax. And remember, this is just in the committee, just a proposal. They haven't voted it out yet. But I find this of interest. The committee proposed a new tax on wealthy individuals, trusts, and estates, a 3% surtax on those with an AGI of more than $5 million. The levy would go into effect next year. So it's a 3% tax on what, though? So it's a 3% tax on those with adjusted income, but it also says So is that, what is that? So if you have adjusted income of over $5 million, you pay an extra 3%. I got no problem with that, none. As opposed, that's like a wealth tax, but it's a wealth tax on income, not on, it's a tax on income, not a tax on wealth. This is the problem. At some point, you got to tax wealth, not just income. But I get it. I mean, look, I got no problem with this at all. Step up in basis. It doesn't mention any change to the current law that allows heirs to get a step up in basis. That limit that Sniffy Joe wanted to do was fiercely opposed by lawmakers in rural areas. The person says she doesn't think the Democrats have given up on ending this rule. Yeah, I don't think so either, but because there's tons of money in that step-up basis. But they also know there's tons of money in IRAs too, just FYI. Estate and gift exemptions. All right, the 2000. Let's see, the current exemptions will expire in 2026. Instead, they'll cease to end by this year. The 2017 tax code doubled the okay. The levels would revert back to their lower levels of nearly 5.5 million for individuals and twice that for couples, plus extra for inflation. Estates and gifts exceeding those thresholds are taxed at 40%. Yeah, again, that doesn't bother me so much either. So you got it's still portable. So if husband uses it, doesn't use it, you don't need to do a Q-tip for your wife. It's still portable. She can use what you did not use to pass the rest. I got no problem with that. The House draft takes aim at large retirement accounts, all right? If an individual's combined IRA and 401k has more than $10 million, she would be banned from making contributions to her Roth IRA or the traditional IRA in the current year. The limit would only apply to single taxpayers and marrying filing separately. If an individual has more than $10 million in a Roth or 401k, they'd be banned from making further contributions to a Roth or traditional. Okay, that's just not that big of a deal. Roth's max is $7,000. Companies would be required to report annually to IRS all employer plans with balance over $2.5 million. Oh boy. RMDs for high income taxpayers with large accounts would rise sharply starting next year. Those with retirement accounts have between 10 and 20 million and who earn more than $450,000 have to draw half of the amount in excess of. Whoa, that is huge. Those with retirement accounts between 10 and 20 million and who earn income tax at the new rate, $450,000, would have to withdraw half of the amount in excess of $10 million. Whoa. What if it's in a Roth? If their retirement accounts hold more than 20 million, they'd have to withdraw either an amount that takes the accounts down to 20 million or the aggregate Roth balances. All right. This is Peter Thiel. There we go. This is due to Thiel's account, referring to the $5 billion Roth IRA owned by Peter Thiel. Some ultra high net worth investors have replicated strategy to the dismay of Democrats. So wealth advisor, called the RMD language the most concerning bit. There's going to be a lot of fallout for people who have wealth but don't necessarily spend a lot of it. Well, I mean, that's the problem. Wow, look at that. If you got between 10 and 20 million, you got to withdraw at one time the amount that exceeds $10 million. Woo! That is serious. All right, 1 second. Finney. Salt cap. The House proposal doesn't mention the 10,000 limits on salt, state and local tax deductions. They're continuing to work on it, though. Trust. The House contained a complex proposal to curb people use grantor trust to push assets out of their states. I know Obama was big on grants. Grantor retained annuity trust, that was called. I can't remember. But I think it was 2, 5, and 10-year ones. I think he was trying to get rid of the 2 years. I'm not even sure if he did or not. All right, a lot of proposals floating around, but that RMD one's interesting. Yeah, we'll have to see how it shakes out, man. Don't be one of those people who say, they're only going after the rich now. They're going to get me later. Maybe. The point being, again, is be poor on paper. You don't have to worry about this stuff. You just don't. So a lot of interesting stuff in here. We'll see how it shakes out. This is what happens. Elections matter, my friends. So you're sitting on your hands because, look, in Fulton County, my vote counted. It just counted for Biden. But at the end of the day, if you're sitting there in a middle purplish congressional district, well, the way you make sure that you don't get hit with taxes is to vote accordingly. It's just that simple, man. And if you don't, you're gonna rue the day you forgot. But the most important thing is to vote locally. Stop worrying about the president and the Senate. I mean, look, it's good. We want Herschel Walker to smoke Raphael Warnock, but stop worrying about so much the Senate and vote locally. Make sure you vote and you're off your elections. 2022 is coming. All right, love your thoughts. We'll see you.